Hello, this is Fred Sade, and I'm the creator and your host today of this workshop entitled Do Presidential Elections Really Matter? As you can see, I am the managing partner at Money Matters USA and the president at Foundation Insurance Services. A little bit about about me. Wow, sorry about that. Uh, well, I'm not getting any cooperation. So, I uh, talk about topics that relate to pre-retirement and retirement. That's what I think about, whether it's Social Security, IRAs, qualified plan assets, taxes. Um, those are the things that I'm interested in. I've written for a major newspaper chain. I'm a retired university professor, and I'm also a principal consultant of a public company, and I did a radio program for 3 years, and for the last almost 3 years, I do a weekly podcast. I do a lot of writing. A lot of it is ghostwriting, some of it under my own name, but not all of it. I'd like to start with two lessons that have been taught to us by Dr. Albert Einstein. And Dr. Einstein had powerful insight, which is that the thinking which solves a problem needs to be different than the thinking which creates a problem. Now, think about this for a moment, because all of us, time to time, are working with a particular problem, spend a lot of time, maybe we've invested money and effort, and we don't want to give up. And so we put more money and more effort into it in the hope that eventually we work at it long enough, hard enough, we're going to solve that problem. That problem will yield. And Albert Einstein is saying, no, it won't yield. You have to think about it in a completely different way. He also goes on to say that the measure of intelligence is our ability to change. So you have to be open to thinking about things in a new way and to see if some of the things you think you know, maybe that information is outdated and you have to be open to new information. This is the damage on a World War II bomber. This is the 8th Air Force, the American bomber group that was stationed in Great Britain. So now why am I showing you this? Well, if you look at the if you look at the damage that's on this diagram, you'll see that this is damage sustained by bombers that successfully made it back to their bases in England. The issue is where to put additional armor. Should they put it around the pilot? Should they put it around the tail, the wings, around the fuel? Meetings went on within the bomber groups, within the 8th Air Force. And finally, at one meeting, a member of the statistical unit, Dr. Abraham Wald, stood up with great courage and said, you know what, we're thinking about this in a completely wrong way. All of these bombers, although damaged, made it back to England. So therefore, additional armor is not needed in the indications of where these planes have been shot up. No, the issue is why don't the bombers come back? And we have to look at why those bombers that fail to come back, they're the ones that we need to provide the additional armor. And we have to figure out if you look at the diagram, you will see that you don't see anything around the engines. And so Walt concluded that it was the engines that needed the protection. So question that I'm raising with you is, do you have armor, do you have protection in places that don't need to be protected? And are you missing the essential where you do need protection? Or is your advisor giving you advice to armor up, to protect in areas that really don't need protecting, and you're missing the areas that do need protecting? So here's what you're going to learn today. First, an overview. We're going to try to decode some of the Washington think speak. We're going to talk about taxes in an election year. Does Wall Street really care who wins? And does it matter to Wall Street? We're going to talk about some strategies to protect your assets and your legacy. Keep the money and the assets that you worked your whole lifetime, keep it within your family. And finally, a plan for elder care and the purpose of protecting yourself for elder care is to protect your assets. Excuse me. I've been doing some research and I'm trying to find out in this research, um, what do you think? Do you think we will have a split government, divided government, or do you think we will have one party control of Congress and the executive? Think about this for a moment. And what my research is showing me is most folks think we're going to have split government. Doesn't mean that's right or wrong, but that's what the consensus seems to be. And my second polling question is, do you think, excuse me, do you think taxes will go up? Taxes are going to go down? You think taxes will stay flat level? The consensus for my research is that most folks think taxes will go up. So let's think about the implication of why taxes are likely to go up. Right now, we're in a 2-year election cycle. It's very disabling. It causes legislative risk. And it also causes risk in terms of the budget. A 1-year budget doesn't give us enough time. It doesn't give Congress enough time. And so therefore, they continue to pass these continuing resolutions. There's just not enough time, and that time can only be gained by at least going out 2 years in order to get a budget. Well, this 2-year cycle is difficult because people are waiting, or politicians are waiting, or interest groups are waiting for the next election, hoping they're going to get possible change. And if it's not, they're going to work the courts to see if they can get what they want. Now, retirement is more than 2 years. It averages 20, 27, 30, even 40 years. So it's not a 2-year event. Therefore, how do you protect yourself against legislative risk from a destabilized system over your entire retirement life cycle? And we know that Wall Street believes that divided government is best, and that's the same belief that a lot of folks have, according to my research. So how do we get confidence about what we're doing? And we have to do that in the face of probably rising tax rates. We do that through tax diversification and tax optimization. In other words, why are we doing that? We're trying to do that. We must do that actually to address risk. And what risk are we addressing? Political and legislative and budgetary risk. Those are the things that we are facing right now. So when we're looking at taxes, we're looking at taxes in this election year and actually beyond. Now, eventually, and that eventual isn't going to be that far away. Taxes are going to go up, and we have to be okay with our strategy and how we implement the strategy, regardless of which party controls Washington. And remember, there's 3 elements. There's the executive branch, the White House, the legislative branch, both houses of Congress, and finally, the bureaucracy. Don't forget about the bureaucracy, because they're part of this cocktail, this mix. So you have to protect yourself again against taxes and legislative risk and budgetary risk. And this means at the end of the day, you have to protect yourself against government because government is the risk here. So assuming the Tax Cuts and Jobs Act either sunsets in whole or in part, then for most taxpayers, taxes are going up. The deductions rather will be cut in half for most people. The SALT limitation, the $10,000 cap, is going to go away, but we're going to get the alternative minimum tax will come roaring back. I'll talk about this later. We're also going to get the Pease limitations back. Pease was a congressman, and the purpose of the Pease limitations is to limit the ability to itemize deductions. Another important elimination is the 20% qualified business income deduction. This is the 131A deduction for LLCs, LLPs, PAs, and sub-S's, and that gives them rough equality C corporations. And the unified gift and estate tax is going to be cut in half unless Congress does something else. Now we know that Senator Warren wants to cut this to 3.5 million, and our software has both the 6.5 million and the 3.5 million. And there's also interest in cutting it back to 2.5 million. Again, it just depends on who wins the election. Does the Democratic Party get the trifecta? And then I think we see a number of these things come to pass, or do they not? Impossible to know right now. Well, what's some of the costs of these higher rates? And this is a good way for you to see this. At 100,000 in 2024 compared to 2026, this is reducing the standard deduction. This is increasing taxable income, and the tax increase is $3,300. Now, this change from 12 to 15%. Well, you may say that's only 3 points. It's not 3 points. It's actually a 15% increase. You have to do the math to see how significant the going from 12 to 15% actually is. And this follows suit with all the other uh, amounts of taxable income. So at 250,000, the increase is almost $9,700. And again, it's not just a 3 or 4 or 1%. When you do the math, these are very, very significant increases. And we are these 2026 numbers are being shown to you in 2024 dollars. And they're all married filing jointly. So the actual hit could actually be greater once you go to 2026 dollars. Here's the alternative minimum tax, and you can see at 109,900, it's very, very significant. The phase out is significant. It's an alternative tax system. You do your taxes in the regular system, and then you do it a second time, and this eliminates deductions such as your state and local taxes, real estate taxes. It gets rid of personal exemptions. These are the most important ones. There are others. So the P's limitations are very, very nasty. The Tax Cuts and Jobs Act simply said they won't be enforced. They didn't actually repeal the P's reductions. And once you eliminate the 131A deduction, you are pushing the tax rate right up to the personal bracket of 39.6. So this makes an enormous difference because the majority of businesses in this country are pass-through entities. Again, sub-S, LLCs, LLPs, PAs. This is a punishing increase in the tax rate. Another area that people tend to ignore is tax efficiency in their portfolios. And David Blanchett, Dr. Blanchett, who used to be with Morningstar, now with PGIM, which is the quantitative side of Prudential, points out quite rightfully that most people don't think about the impact of taxes on their portfolio or portfolio management. And he really hits the nail on the head here. When you're analyzing portfolio management, you have to look at what is the turnover ratio, that is, how much buying and selling goes on, and what's the implications of that? Does that affect your after-tax return? Does the gains and gains do get passed through, and you can experience what's usually called phantom income, and this phantom income is passing capital gains to you, even if you didn't participate in the run-up. When the portfolio is rebalanced, is there a tax cost? And another point is the tax drag. how much when assets are not invested or they're being invested in something that's taxable, how much is the reduction in your earnings caused by taxation. So these are issues. All of these issues are really important, but they're not usually considered. So think about these questions. Currently, are you subject to high tax rates, and will you be subject to even higher tax rates or if the Tax Cuts and Jobs Act sunsets? How efficient are your investments? Are you invested in high turnover mutual funds? Is your portfolio constantly being turned over? And every time the portfolio is rebalanced, are you being faced with taxes that are being forced out to you? Is your CPA saying something to the effect, "Oh, don't worry about paying more in taxes. It's really a sign of success." Or as some CPAs tell high-earning clients, or hey, you should be happy to pay as much in taxes this year or next year as you earned in the previous year. Is that what, if your CPA is saying that, is that acceptable to you? So let's talk a little bit about the deficit itself. Sorry about that. This keeps jumping around. The Congressional Budget Office, CBO, says it's estimating the current deficit of 1.8 trillion in 2023 is 1.6 trillion. The CBO believes that with the expiration of the Tax Cuts and Jobs Act over the next 10 years, the U.S. debt will climb to 50 trillion or in excess of 122% of GDP by 2034. The Committee for Responsible Federal Government has a different set of estimates, but I have to tell you that all these estimates are intelligent guesses, which could be right and which could be wrong. And also tell you that at the beginning of every year, all of the tax revenue that comes in is spent on Medicare, Medicaid, Social Security, and interest on the national debt. There isn't a penny left over once that happens. So Congress, on average, is going to spend 1.7 to 1.8 trillion. So there's a simple way to think about where the debt is coming from because there is no free cash flow after the spending on Medicare, Medicaid, Social Security, and the national debt. That's it. It's all gone. Now, the Committee for Responsible Federal Government believes that Vice President Harris's plan, to the extent that that's been um, stated and not changed since the slide was done, would increase the deficit over 10 years to an additional 3.5 trillion or 133% of GDP. So that's on top of this 122.4% of GDP with the expiration of the Tax Cuts and Jobs Act, which kind of expects that there's no additional spending going to occur. Again, it's a very static analysis, and in that respect, it's a bit misleading. Okay, so here is Vice President Harris's plan as I understand it. It would extend the Tax Cuts and Jobs Act for households earning under 400,000. It would expand child and the earned income tax credits. The earned income tax credit is a refundable credit to people who do not pay income tax. But the Trump campaign is in agreement on expanding the child and the earned income tax credit. Candidate Harris would expand the Affordable Care Act. She would establish a $25,000 first-time homebuyer tax credit. The Trump campaign is in agreement with a first-time homebuyer tax credit. Both candidates want to exempt tips from federal income tax. That makes a lot of sense because the cost to collect the money is less than the revenue that comes in. Candidate Harris wants to increase the minimum wage. She wants to increase spending on pre-K and childcare. She does want to increase the corporate income tax rate from 21 to 28%. She also wants to eliminate the 20% deduction and 131A deduction for pastors. And she wants to subsidize the Part D Delta premiums, the Part D premiums which is the Medicare drug plan for some classes of individuals for up to 1 year. That's about a $5 billion cost. All right, the Trump plan. Trump wants to continue the Tax Cuts and Jobs Act without modification. And the only modification that he would consider is to eliminate the SALT cap. He would exempt overtime pay from federal income taxes. That's very clever because, in effect, it's a tax increase. I mentioned tips. He would retain the 131A deduction for pastors. He would cut the corporate income tax rate to 15%. That is significant. He would also exempt all Social Security benefits from federal income taxes. These benefits represent the taxation of Social Security benefits represents about 4% of federal income. I've mentioned the first-time homebuyers. He would secure the border and deport unauthorized criminal immigrants. That's about 4.5 million is his latest figure. He would eliminate the Department of Education. He would reform and reorganize the federal government. You've probably heard a lot about that piece of it. And he would impose a universal tariff of 10% on all imported goods from everywhere in the world except China, which he would have a 60% tariff. Now, let me just say on China, the Chinese government absorbs between 75 to 81% of the American tariffs on Chinese goods. So right now, it's not a big deal. And I believe that these numbers are negotiable on the part of candidate Trump should he become President Trump. That's my opinion. I think that that's an accurate statement, but of course we will see. So what's the cost of the Trump plan? Well, the Committee for Responsible Budget estimates an increase in the federal deficit of 7.5 trillion over 10 years, which is about 142% of GDP. That you have to add in some additional because candidate Trump proposed a deduction for interest paid on automobile loans, and so that would bump this up to approximately, give or take, 7.9 trillion. Now, it's not likely, and this, excuse me, would be my caveat, that neither candidate's plan would be implemented in its totality. I also would point out that the Tax Cuts and Jobs Act is already in place, so you can't say that it's actually additionally stimulative. There's no reason to rescore this because it's already present. Now, tariffs are argued to be inflationary. Trump disagrees. Biden has kept the tariffs, and you can draw your own conclusions here. I believe that any increase in inflation would be fought by the Federal Reserve by increasing interest rates. And I also think the size of the deficit will be of great concern to Wall Street and to the investing class in general, because I think that would raise doubts as to how would the United States be able to pay interest on the debt when, as I've already explained to you, all of the money that comes in through tax collections are already spent on three programs plus the national debt. So that is the size of the debt and also the size of the unfunded liability of programs is a very real concern. Given that concern, I wanted to go back to something that I talked about earlier, which is tax diversification, tax optimization. And this is a tax triangle. And this is a way of breaking out the strategy so that you can better understand it. Now, tax advantage places to put money and put assets include Roth IRAs, Roth 401ks, health savings accounts. If you have access to them, they are unique. They are triple tax advantaged. muni bonds, but currently the interest on muni bonds are included in the calculation for Social Security taxation, even though they're not subject to income tax. And the cash value of permanent life insurance can be used very effectively to create a stream of cash flow. So that's tax deferred. Well, traditional IRAs, self-managed IRAs, annuities, traditional 401ks, 457s, 403bs, and so on and so forth. Anything of that category, which is tax deferred, you get tax-free growth. But when you take the money out, those withdrawals are taxable, as opposed to the Roth, which you pay the tax up front on whatever you're putting into the Roth, and then when you take it out, it's not taxable, and the growth is not taxable either. And the taxable, well, that could be your brokerage account, savings account, statement savings, statement checking, or money market accounts. The importance of understanding the tax triangle is not to be underestimated, because when you harvest money, or take money from these assets, this money has to be taken as income from certain assets in a particular order, in order to minimize taxation and extend the life of your assets, your portfolio. These things are not do-it-yourselfer type things, and you should not do this without professional advice. And I would encourage anyone who is thinking about this to get professional advice. A very, a very famous federal judge, the great name, Judge Learned Hand, sat on the Washington, D.C. Court of Appeals, and he never made it to the U.S. Supreme Court. This quote helps explain why he didn't make it, but it's an article of faith that many people quote all the time, and I have the privilege of reading it to you. Anyone may so arrange his affairs that his taxes shall be as low as possible. He is not bound to choose that pattern which will best pay the U.S. Treasury. It's not even a patriotic duty to increase one's taxes. This is really a very, very important statement that should encourage people to legally protect themselves and not to just gratuitously pay taxes. In section 3, does Wall Street really care who wins? And Wall Street, as I indicated earlier, believes in divided government because it reduces legislative and political risk. Now, we know that Wall Street is divided and people are supporting both candidates. And we also know that the money center bank uh, leaders have talked about who they're supporting, but well, we don't know who that is unless they unmute themselves. All right, so now I want to talk about presidential cycle theory. And during during election years, or I should say in the run-up to election years, we usually see the S&P 500 perform very well. And well, the run-up is usually between 10 and 12%, going back to 1928. And so usually in the 90 days preceding a presidential election, the S&P 500 is up, and 83% of the time the wow. Sorry about that. 83% of the time the incumbent gets elected. Now, here's a little bit about inflation under President Biden. If we take it out to September of 2024, it's about 2.5%. High point was 9.1% in June of 2022. This is based on how the Federal Reserve measures inflation. So we know that different sectors of the economy have experienced much higher rates, such as health insurance or eggs or transportation or milk, bread, shelter. So when the Federal Reserve measures inflation, it eliminates sectors that it considers to be unreliable and, well, too volatile. And that means that inflation in different sectors can be a lot greater than what we're seeing here. So going further with presidential cycle theory, the researchers at Charles Schwab found that the S&P from 1933 to 2015 had increases of 10% during presidential election years. And if you add back in Obama, Trump, and Biden, we show that this correlation still holds. But if you see, the sample size is very small. Now, there's also a 2013 study at the University of Chicago, which says watch the third year in the presidential term because that's when the spending is ginned up in order to have the benefit of that spending momentum in the fourth year, and that accounts for this bump up in the S&P. So, what are the conclusions that we can draw from this? Well, I'd caution that correlation is not causation. There's a lot going on to cause the equity markets to go up and down, to act the way they're doing. We're seeing the interest rates and yield, which are inverse to one another. We see that going on right now in bonds and treasuries. Now, we're going to have to wait for the election to see if the third year momentum theory holds for Vice President Harris. Will it? And will the Democrats benefit down ballot? That remains to be seen. So whichever ways it goes, let's look at some strategies to protect your assets. Well, one of the strategies that can be very effective is to time your Roth conversions. And doing these strategically can be very valuable. Uh, it can hedge you against rising taxes. In a down year, it can be very effective with tax loss harvesting, and it's effective with estate planning. And there are strategies that will be built around which can incorporate the Roth. You also have to think about, what's my time horizon? Will I live long enough to enjoy the break even? What's my current tax bracket? What will my bracket be when I retire? Now, I do want to say that under one theory, if your bracket is low today and it's going to be higher in retirement, which it may be if you have a lot of qualified assets, then conversion to Roth is indicated. Now, you will pay for the conversion, and you do have to look at the IRMA charges. IRMA is income-related monthly adjustment amount. It's an excise tax paid by some people, and it's a Medicare. It's a Part D. Part B charge. Here is the uh, chart that shows you that for 2024 what the costs are, and these are paid every month, and it could be both spouses paying this, and this is on top of everything else. These are Part B, which is the uh, diagnostic testing and the physician, and some injections for protect you against certain diseases. And this is Part D, which is a prescription drug. These are excise taxes, which are on top of. Now, let's do a quick look at a case study. Let's assume we have a couple who are married or 70 years of age and have a worth of $12 million. Current exemption is in excess of 27 million. So they say, we don't have anything to worry about. So why discuss it? Well, let's assume for the sake of argument that their estate grows by 6%. And let's look at what the estate tax problem would be in a few years. Now, the red is the taxable estate, and you can see as this, nothing to worry about here. But if we revert to the Tax Cuts and Jobs Act, limits, you can soon see, and the red shows you as the estate builds up, and how the estate tax liability will build, even if there's some inflation adjustment. Now, you should also consider the fact that we have to think about state inheritance taxes, and it's important here because the states are decoupled from the federal system, and some states start, such as Oregon, start at a very low amount. Some states don't have a estate tax, but they do have an inheritance tax, and these taxes can be significant. So even if you didn't have federal estate tax, you could very well have state estate tax, which most people forget about, and it can come back and haunt you, or at least your heirs. So let's talk a little bit about how do you reduce estate tax exposure. Well, one of the ways to do that is by using gifting strategies, and you can do a dollar for dollar reduction, and it eliminates future appreciation of assets from your estate, which means that you're leaving more to your heirs and a lot less to the Internal Revenue statements. Remember Judge Learned Hand. It's important also in preserving a family business and making it inheritable. Life insurance can be very, very effective here, not merely for the transfer, but also in leveraging situations. I could spend time on that and give you at least 10 important considerations where life insurance will make a lot of sense, but we don't have the time today. I'll do that at some future point. Here are again the assets to look at, because there's so much money in qualified assets. This will only go up, and we know that 85% of households roll over their entire retirement plan balances to IRAs. So these are the IRAs. These are defined contribution plans such as 401ks. These are traditional pension plans in the private sector. And as you can see, these are the pension plans in the government sector. And so these are pensions are more of a government benefit than they are in the private sector. But in any case, this is a looming problem. So bear in mind the fact that most of what you just saw before moves by beneficiary direction. These accounts all move by beneficiary direction. They do not cover probate assets. So therefore, it's imperative that you review your beneficiary directions periodically. Marriage, divorce, birth of a child, these are all life-changing moments. You leave a state, move to another state. It's important to review your estate planning documents and make sure the money would go to the people you want it to go to. There's also a problem using trusts as beneficiaries. It's not that you can't use a trust. The point is that if you are going to do it, you need to get qualified advice in order to be able to do that successfully. When is a trust indicated? What combinations of trust would be effective for you? And this is where a competent estate planning attorney needs to be brought in. We do have the estate planning software that many attorneys use, Estate View, and I'll give them a plug, uncompensated. But the point is that we would want to work with your estate planning attorney, and if you don't have one, we can make some suggestions on your CPA. Now, one reason that why do I say? Well, here you can see that the full implication of the federal income tax and the trust comes in at a very low amount. I mean, 15,200, you've hit the trifecta here. You're at 37%. And then if you throw in the Medicare surtax, you're at almost 41% on only $15,200 worth of income. So this is something that you want to give serious thought to how to address this problem. Now, one of the ways to do this is to use charitable remainder unitrust or charitable remainder annuity trust. The difference is the unitrust can have a different amount of income. It can be a variable amount every year. The annuity trust, the income is fixed. Now you get an upfront deduction upfront for whatever the value of the remainder interest is going to be. That's the amount of money that's going to be left to the charity. Excuse me, but you get that deduction up front. And this is a very effective way to manage assets because you get spendthrift and creditor protection. You do it in a state that doesn't allow any backdoors in. It's going to be very powerful, and it lets you help a charity that you care about. Usually, the income paid to the beneficiary is taxable. So I've said on a number of occasions that trying to estate plan with qualified assets is an impossibility. And I'd like to just spend a moment on this chart because prior to the Secure Act, you could estate plan with qualified assets, but you do that with a stretch strategy. You can do that to some extent today with non-qualified assets, but qualified assets not. So with the stretch strategy, you could take $1 million and it would have been worth 2.6 million, and that would be the asset itself, growth on the asset, and the distribution to the beneficiaries. Now, with the Secure Act and the 10-year rule, take the same $1 million and the distribution is 1.8. So there's a difference between 2.6 and 1.8. Now, if you use a charitable remainder unitrust, take the same million, you can get 2.3 million out. And this is pretty close to, not the same, obviously, but it is pretty close, a lot better than what the Secure Act just using beneficiary directions would impose on you. So just to sum it up, investing and considering different financial strategies you have to consider the tax environment. This is challenging. I know that people often say, "Hey, give me a simple solution. That's what I want. Just give me a simple solution, and that's the end of it." Well, when you're dealing with a very complex, complicated set of problems, sometimes you need a complicated solution. Sometimes the simplest solution just doesn't work. Again, another one of Dr. Einstein's dictas, which is that Occam's razor is great, but the solution has to work. If it doesn't work, then forget about a simple solution. Something that's important that you bear in mind, because I've seen people get up and walk out of an attorney's office saying, "Hey, this is too complicated. I don't understand it." Complicated problems require complicated solutions. Simple problems require simple solutions. If you've got a complicated problem, you need a complicated solution, because the tax set that you're looking at is what you're trying to overcome, to hold those assets, not paying excessive taxes, and keep them in your family. So you also, as Dr. Blanchett pointed out, these investment type decisions can have tax consequences. People don't normally consider the tax consequences. When we talk about tax diversification and tax optimization, we're ordering how we use the tax deferred, tax free, and taxable vehicles, and these provide different strategies of how you can optimize your distribution of income, and doing it in order to pay taxes at the lowest possible effective marginal rate, and also to prolong those assets, to lengthen the longevity of the portfolio as long as possible. Another consideration, coming back to the Roth, and I think it's important to emphasize this, uh, doing a Roth conversion may make a great deal of sense, but you may not get all the tax benefit in your own lifetime. The tax benefit may go to the beneficiary or the beneficiaries. And this is a question of how you do the calculation, which you're doing a different calculation, which is not based on the differential of the taxes per se, but it's a net present value calculation, and then seeing what the impact of that calculation will be on the distribution of income, factoring in the taxes. It's a more complicated, I realize, again, it's a more complicated calculation, but I believe that it is a more accurate one. Again, there is academic research on all of the things that we have talked about thus far. So I'm not out in left field making this up on my own. Okay, so this is part 5, which is health. Why do we look at health? Well, health, if we look at it as a way to preserve assets in our planning, then it does make a lot of sense. Now, understanding healthcare costs is really essential to us, and people are living longer today. These longer life expectancies, well, we can measure those. There are some very effective calculators, and there are also genetic testing that can help, and is pretty accurate in its predictive ability. And so when people lived 7 years into retirement, that was one thing, but that's not the case now. People in 20, 27, 30, 40 years into retirement. And the CBO predicts that by 2050, 1 out of every 100,000 Americans will be over the age of 100. So, with Medicare under enormous strain, and with some uncertainty about how do we deal with Medicare, how do we shore it up and not just give it more things to do, uh, estimating healthcare costs, estimating longevity, and putting this into the retirement income plan is absolutely essential. Um, for most people, their second largest expense in retirement is healthcare. And we're not even looking at long-term care costs, and you're looking at the fidelity estimates, which is a 65-year-old couple will need about 315,000 to pay for medical expenses for the remainder of their lives, and this doesn't take into account excessive inflation, and it does not consider long-term care costs. Now, think that is very difficult for people to comprehend is the cost of assisted living, healthcare, home healthcare, and whether or not adult daycare, whether it's not for profit or for profit, that's being used. And people often think that Medicare covers um, nursing care. It covers skilled nursing care theoretically to 100 days, but I understand that that's very hard to get the full 100 days. Now, we do know that if you want statistics, we do know that on average, men will survive about 2.2 years with long-term care events, and women 3.7. Now, these are averages, and it comes from the U.S. Department of Health and Human Services, since since Medicaid pays for most of the long-term care in the United States. But it's important to have a strategy to protect assets. So if you're going to use Medicaid, that requires a strategy, and there are implications, things you can do. If you're not going to use Medicaid and you're going to use Medicare and you're going to use some form of insured coverage in relation to your other assets, that needs to be planned out as well. So to look at some of the strategies, here are some of the risks that you have to look at if you're going to say, well, I'm just going to pay out of pocket. Well, what about the volatility of the market? The market goes up, the market goes down. What happens if it's down and you need to hit that portfolio hard? Interest rates normally depress the value of equities. Inflation is something that we haven't had to deal with in the past, but we do have to deal with it now. The single most important issue for a retiree is sequence of risk and return, because you don't have money coming in from your job, from your work. So when you're working, new fresh money is coming in. So it's different. You have money to work with, and you're not dependent on the stock market. On the other hand, when you're totally dependent on equities for your income or bonds, then you can have a problem. If the market is down in the first 3 years before retirement, in the first 3 years into retirement, that portfolio is likely to be exhausted. And then, of course, longevity, which we've talked about quite a lot, but this is something that needs to be taken into consideration, shouldn't be ignored. This is not a short-term problem. Um, the average span is going to be about 20 years. It could be longer. We use the Society of Actuaries longevity calculator. Penn Wharton has a good calculator. Also, there are others out there. I don't know how good they are, but I'm told that they're valid. But it's important to do a longevity analysis and then decide on a percentage. You want absolute certainty at a 25% and very conservative estimation of longevity, or do you want to roll the dice and go to 10% longevity estimation? It's up to you, but whichever you pick has to be planned for. So let's sum it up. Healthcare is going to be a major expense in retirement. It's the second largest expense. This has to be included in retirement planning. You can't just wing it. And here you have to have some kind of bridging strategy. Here, the only bridging strategy really are life insurance, annuities, a reverse mortgage, um, or you could use a bond ladder or an annuity ladder. You can use TIPS, Treasury inflation protected securities. There are strategies that can be used for bridging, but you want to have enough certainty in these assets that you can build. What you're trying to bridge here is to Social Security, and having an optimal claiming strategy, and then having sufficient income to meet your fixed expenses. So I also want to talk about estate planning. It's implicit in what I have been talking. You need to consider the fact that you are going to have to deal with probate costs. You are going to have to admit that as you get older, you do lose mental capacity. You want to protect yourself as well. Medical debt is a major problem. You have to protect yourself or your family on the issue of controlling assets. There may be a special needs situation. You want to protect against mismanagement of money within your family, or you can be swindled just as easily. Money can be lost. And again, as I've said earlier, dealing with estate taxes. So this is just a quick review so you can see what happens in the brackets when if the Tax Cuts and Jobs Act expires. So you can see how the increases occur. So these are important. We've talked about it, but this is a quick review. And this is estate taxes before the Tax Cuts and Jobs Act and after the Tax Cuts and Jobs Act. This is, we don't know where this is going to go. As I said, I'm going to talk about cost basis in a moment. Um, these are some of the ideas coming from President Biden's ideas. Many of these have been adopted by Vice President Harris. You know, there are some attacks here that are very fundamental on the use of trusts, and this attack on generation skipping transfers is very potent to protect assets from being remaining in the family. It also attacks a very effective technique, which is the defective grantor trust. Now, the trust is not defective in the sense that it was improperly drafted. It's defective from a tax standpoint, which means that the person that created the trust pays the income tax on the assets that grow in the trust. And the reason for that, as you saw before, is because the maximum trust tax is at 37% and only a little over $15,000. So this shields the trust from taxation on appreciation on the assets that are transferred. The administration is the Biden administration is proposing recognizing gain on appreciation once you transfer the asset in. Now they've done this both times in their Green Book presentation. It was also discussed during the Obama presidency. And I have every reason to believe that candidate Harris is in agreement with this as well. Now, let's talk about the step up. When you inherit an asset, that increase in the value of the asset is not taxed. So in other words, let's say you bought let's say your mother bought an asset for $1 at the time of her death. It was worth $50. That difference you get income tax free. If you sell it the day after you inherit it, it gets taxed at the 20% long-term capital gain rate. There's no holding period. So what the administration is proposing, and that is to eliminate what's called this step up in basis. So in other words, not only would the value be taxed, but even if you didn't sell it, that appreciation would be taxed. That's called unrealized gain, and it would be taxed continuously, and that would level the value of assets. And this is not just for trust. It could be trust, it could be partnerships, it could be personally owned property, anything where there's a recognition of gain event within the prior 90 years. This also is important in family-held businesses because it eliminates valuation discounts for in-family transfers. And this is very important because it's very difficult for a family-held business to get to the next generation, um, get to two generations, three generations, almost impossible. So this is very significant. Excuse me. So my advice is don't wait for clarity. You're not going to get clarity. Plan now that this 2-year cycle has not changed. Um, if you wait for clarity to know exactly what's going to happen, it will be too late. There's a limit on the number of CPAs. CPAs are a dying out profession. Most people are using online software. They don't use a CPA or a tax preparer any longer. Gifting is very effective. Hopefully, there's charitable intent, but like many people, I suspect that more gifting is done because of the tax implications than is done for reasons of charitable intent. But it would be nice to have charitable intent and explore the really powerful and most effective use of life insurance in these situations. So, to sum it up, mom and dad and grandma and grandpa talk to you about a rainy day. Well, remember, the early death of a spouse is a rainy day. Healthcare expenses in retirement, including long-term care, that's a rainy day. And sequence of risk early in retirement or right before retirement, those are rainy days. Those need to be addressed. So how will you address them? Well, you got three choices. You can continue to worry, make bad decisions, worry about your next step, worry that you can't sleep, constantly worry about your money. Or you can buy products. No plan. You have no written plan. Just hang in there, write it out. Everything will be all right and go with the 60/40 portfolio. Or you can let me help you and my team of qualified advisors. So what do we have to offer? Well, we can provide you with a written plan, an actual written plan that will give you the ability to understand for the first time your money. We can also do a risk assessment of your current assets. And if you wish, we can show you how to lower your risk with those assets. We can look at the fees you're paying and what you're going to pay with a portfolio that has less risk in it and fewer fees. Analyze your retirement income plan. Where's your income going to come from? We're going to insist on a budget. Either you make it up or we'll help you create it, because without knowing what your budget is and how much money you need, it's impossible to know what you want your money to do for you. We'll look at your income taxes, how much you pay, and how we can increase your cash flow. This is the most effective way of creating that emergency account and also minimizing taxes and uh, making sure that you can overcome inflation. We'll do a legacy analysis, the estate planning, showing you how you can pass assets to your beneficiaries when you're gone. The entire plan in writing, signed by the advisor. So again, this is a free, no obligation second opinion. Our program is called Red Light on the Dashboard. It's the thing that you don't want to see, and you would stop if you see it in your automobile, in your car, in your truck. Now, for the first time, you're going to find out where you stand financially. You're going to understand the plan. You're going to have a plan. You'll find out how much risk you have right now. And if it's too high for you, you can get it down. You have to find out how much income you can take out of your assets, and you'll know exactly how long it's going to last. You have to find out how much you're paying in fees, the real skinny here, how much you're going to pay in income taxes when you're retired. You have to find out how much you can leave your beneficiaries. You'll get everything about your money in writing. It's the first time this has ever happened for you. So right now, like most people, you're probably at a crossroads in your plans for retirement. Do you do the same thing? Einstein said, do the same thing, keep worrying. It's Einstein's definition of insanity. Keep risking, keep worrying, keep underspending, which is a major problem in retirement. People don't enjoy the retirement because they're afraid of running out of money. or get a free second opinion. You can protect your money, increase your income, reduce your fears, feel secure, enjoy your life, and stop worrying about money. You get to control. For the first time, you're in control. Now, if you're serious, you want to have a well-written, secure, written retirement plan, we can help you. And here's our total sales pitch. Sit down with you one-on-one, find out where you stand, help you with your goals, help you articulate them. We're going to listen to you, so you'll tell us what you want to happen. Meet as many times as is needed. We're not charging you for the time. Design the plan with you, a written plan, reduce risks against losses. We're not going to tell you to hang in there and ride it out. That's a crazy strategy. We're going to help you create a dependable lifetime income plan, replace your paychecks, avoid the sequence of risk return, and if it does happen, it won't be a deal killer. Show you how you can invest for growth without excessive risk. So for the first time, you're going to understand your money. You stop worrying, and we're not going to obligate you to do business with us. So most people spend more time planning their 2-week vacation than the time necessary to plan their 30-year retirement. Again, you get a free second opinion about your money. You get a customized retirement plan focusing on income, risk, taxes, fees, and legacy. We're not going to charge you for the fees no matter how many times you meet with us. There's no obligation, there's no pressure, and you can walk away if that's what you decide to do. It's all free and it's all guaranteed. So here's how to reach out to me, Fred Sade, or 800-593-8188, 800-593-8188, or you can reach us on the internet at moneymattersusa.net/contact, moneymattersusa.net/contact, or email us at postmaster at moneymattersusa.guru, postmaster at moneymattersusa.guru. Easiest is to reach out and call 800-593-8188. I promise you we do not use pressure. We are not high pressure people. I want to thank you for holding out and hanging in this long, and I hope you enjoyed the presentation. Let's hear from you. Give us your feedback. Thank you so much, and stay well for now.